Alright, for this video I wanted to cover depreciation recapture on the sale of rental real estate. So I've got a few other videos I've done before where we cover unrecaptured 1250 gains, 1231 gains or losses, and the various types of kind of issues that you have when you sell rental properties. For this video, I really want to be precise in giving an example of where you have true ordinary income depreciation recapture under 1250. So what you're going to see is this is really not an issue for most taxpayers now because we'll get into the details later, but most rental properties placed into service now are just automatically using straight line method. You don't have any accelerated issues. And so it's only when you had accelerated depreciation on the rental property where you have this ordinary income recapture. So I've got a few things in front of us here, the slides. I've got a sample return, a 1065 real estate partnership where we'll show how the sale is recorded and the various character items for the gain itself. And then I've got open the IRS publication 534 here, which covers depreciation on property placed into service pre-1987. And so this is where we get the accelerated rates. And so the table that we're going to go through here shows how the depreciation was taken in those earlier years. So if we go back to the slide here, just some background on what the 1250 issue is. So there's two separate concepts of depreciation recapture for real estate, right? So we have unrecaptured 1250 gains and then section 1250 recapture, which is the ordinary piece. So generally speaking, and this applies again in most cases now because all property was just placed into service and depreciated using the straight line method, but when we have unrecaptured 1250 gains, this is the section 1250 depreciation recapture that is a piece of your 1231 gain. So unrecaptured 1250 gains, they are treated as capital gain, so long-term capital gain, but they're subject to ordinary income tax rates, but it's capped at 25%. Right, and again, it's still treated as long-term capital gain, that depreciation recapture, which means that if you have other capital gains, you can offset those amounts, and it works out really well for the taxpayer. Now, the subject of this video is Section 1250 recapture that is truly ordinary gain and going to be subject to ordinary income tax rates. Now, this applies when we have property that was placed into service pre-1987 and depreciated using an accelerated rate. So this is important to remember because right now, when we think of placing real estate into service, we're depreciating it straight line using either 27.5 years or a 39-year recovery period, right? So if it's commercial real estate. Pre-1987, we had not only accelerated rates, but there were different classes of property, right? We had 15-year property, 18-year, and so you had to be very careful about which one actually applied and then apply those accelerated percentages. So the example we've got here where this is going to be an issue, we have our real estate entity here, the LLC. This company bought a commercial building in 1981, so this thing is pretty old, right? So we've had it for roughly 40 years. We bought it in 1981 for $3 million. And at the time, the company allocated $150K of the value to the land and then $2.85 million to the building. Now in 1981, given this year, commercial real estate fit into a 15-year property bucket, right? And so during that year, so again, this is all pre-1987, we were depreciating using the ACRS method, right, which is the accelerated cost recovery method, and the property was being depreciated at a much faster rate and front-loaded, right? So what we mean by front-loaded is, and we'll look at the table, you take a larger percentage of depreciation in the early years, and then it kind of phases out to a smaller percentage. Now, because we were on this 15-year method, the accelerated method, the property is fully depreciated by the time we sell it, right? We're talking 40 years later, so all of the property has been depreciated now, and so the adjusted basis we have of the property is now only $150,000, and that's because of the land, right? So remember, land is not a depreciable asset. Now, if we go take a look quickly at the balance sheet, I think this will make it a little clearer, right? So if we look at the 1065, the balance sheet here, at the beginning of the year, this is what the books look like. So pretty straightforward. We just have cash, and then we can see here the building on line 9A, 2.85 million, the land there, 150,000, and we could see that at the start of the year, going into the sale, the building was completely depreciated, right? And again, that's because we've had it a long time, right? I mean, even if you hold the building for from inception until, many decades later, you're going to have, a fully depreciated asset. So that's what we've got here, right? The 2.85 million was the cost basis, but, many years ago, we exceeded, or we went up to that limit of how much depreciation we could take. So we've got a fully depreciated building, and the land is the only thing remaining that's not depreciated. So here's the sale and cost allocation, right? So remember, we sold the property for $3.4 million, and based on the fair values, we are allocating $3,075,000 of that sale price to the building, and then $325,000 goes to the land. The adjusted cost basis in the assets is the following here on the second line. So again, we can see the building, because it's fully depreciated, the adjusted cost basis is now 0. The land, which was not a depreciable asset, remained unchanged for the last 40 years, right? So 150,000 is the land basis. So the adjusted gain on these two assets, we've got 175,000 allocated to the land, and then 3,075,000 of gain to the building. Now, as far as character, the land here, this was an asset used in a trade or business, held for more than a year. So we've got Section 1231 gain on the land portion. Now, the building, and this is where it gets complicated, and we'll go through the example. But the building component here, the gain might be this 3.1 roughly million of gain, but it's going to comprise a couple of different items, right? So we're going to have Section 1231 gain, we're going to have unrecaptured 1250 gain, and then we're going to have that ordinary 1250 gain recapture because we had that accelerated method, right? So let's look at the last slide here, and then we'll go through the return. So I want to run through the fact pattern here again, the numbers in more detail, and then I'll show you on the return how all this gets reported. So the property, again, we were depreciating it under the ACRS method because it was placed in the service pre-1987. And then when 1987 hit, we switched to the straight line method, which was okay, right? You're generally always allowed to switch to the straight line method if you use an accelerated one, and it's not a method change that you have to get permission by the IRS. You can just go ahead and do it and change it going forward. Now, because the property was depreciated using this accelerated method, the sale of the asset is going to have a component piece that's ordinary Section 1250 recapture, right? And the amount of the ordinary recapture piece is the excess depreciation over the straight line. So in other words, what you have to do is you figure out how much depreciation was taken using the ACRS method, figure out how much would have been taken if we use straight line, and then that difference is the ordinary 1250 recapture. So in this example here, from 81 through 86, the company claimed depreciation of 1.368 million. Had they used straight line instead, they would have only deducted the 1.06 million there, so 1,068,750. So the excess was 299,250. If we go look at the table really quick, so you can see how kind of the depreciation was computed in those years. This is the ACRS percentage table for 15-year property. So the way this table worked is you figured out what month did you place the property in service during your tax year. So month one would be January, right, for calendar year taxpayers, January, February, March, so on. So our property was placed into service in October, so the 10th month of the year. So the first year depreciation was this 3%. So 3% of the cost was depreciated. In year 2, 11, in year 3, 10%, and so on down the list. Now again, you can see here, this is what we mean by front loaded, right? Larger percentages are being deducted in the early years, and then it tails off to 5%, and then the last year 4%. So not only did you have this front-loaded accelerated method, but look, you got a 16-year recovery period versus 39 years is what we have now, right? When we have commercial property, straight line method spread out over 39 years. Pre-1987, you had this 15-year property recovery period, and you have the larger percentages in the early years. So that's why we have this recapture issue. Okay, so here are the numbers again. So we've got the sale price was $3.4 million. Their adjusted basis was $150. So the total gain that we're working with, the economic gain here, is $3.25 million. And then so when we break out the $3.25 million into its various components, what we're going to see is we've got Section 1231 long-term gain on the land, right? That's the $175,000. We've got the ordinary Section 1250 recapture piece, $299,250. Unrecaptured Section 1250 gain, $2.5 million, and then the Section 1231 long-term piece on the building is at $225,000. Okay, so let's look at the return and see kind of how these numbers are flowing through. So when we look at the tax return, the sale of the property is recorded on 4797. So we've got our real estate property here. Now, generally, when you sell 1250 property, you're reporting it in Part 3, right? So we've got our gain from the sale of the building is being reported here, and then we are separately stating the sale of the land here in Part 1, right? So Part 1, report the sale of the land, the gross sale price that was allocated to it, the cost basis, and the gain. And then the building, the Section 1250 piece for the building is reported on Part 3 on page 2 of the 4797. So we've got the sale of our building here, right? There's the date of acquisition, there's the date sold. The gross sale price as allocated to the building, right? Remember, we sold the property for $3.4 million, right? That's the total sale price reported up here on line 1A, but we have to allocate it between the building and the land. So $325 was allocated to the land, and then that remaining piece, the $3.075 million to the building. Now the cost basis there in the building, remember, $2.85 million, and then the depreciation that was taken over the years was also $2.85 million in total, right? Because we've had it a very long time. So our adjusted basis is 0. There's our gain on the building. Now, this is where we have the ordinary recapture piece. So on line 26 here, it asks us if we have 1250 property, which we do, if straight line depreciation was used for the total, right, you can skip this section, right? But in our case, we didn't do that, right? We had property placed in a service in the early 80s. We used an accelerated method until we switched to straight line. So here they're asking us, what was the additional depreciation taken after 1975, right? So between 75 and through 86, what was the extra amount we had? And there's that $299,000, right? So the $299,250 is the portion that was the excess taken during that period. Now, again, what's really important to remember here is this does not change the overall total amount of the gain. What we're doing here is we're just separating the gain into the various components. So the $299,250 is going to be the Section 1250 ordinary income recapture subject to ordinary tax rates. Okay, so we've got the $299,250 reported there on line 13, and then this is ultimately reported on the $88.25, where we report all the rental income and expense. This is reported down here on line 19 as the ordinary piece. So the $88.25 is where we report the gross rents and all the expenses for the period. And then to the extent you have any kind of Section 1250 ordinary recapture, it's reported here on line 19. Now remember, if this property was placed in service, let's say in the 90s, and we didn't have any accelerated depreciation, you wouldn't have any line 19 item, right? Because again, that we would just have unrecaptured 1250 gain that wouldn't be ordinary. But in this case, we do have a piece because we had property that was placed into service in 81. So there's the ordinary piece. And then so now when we look further at the breakout of these gains, we have the 175, which is 1231 long-term capital gain, and then the amount that's going to be 1231 and the unrecaptured 1250 is whatever's left over after we take out the ordinary piece, right? So we have the 3.75 or 3.075 million of gain. If we take out the 299,000 from that, that's what we have left over that is going to be the Section 1231 long-term gain and then the unrecaptured 1250 piece. Okay, so if we go back to the slide, you can see where the breakout is again here. Remember, we saw the 175 on the land, we saw the 299,250 ordinary 1250 piece on the sale of the building, and then the difference is there, the unrecaptured Section 1250 gain, that's the remaining depreciation that's being recaptured. So if you add these two, so if you take the 2.5 million and then the 299,250, so I'll do that really quick just so you can kind of see where we're coming up with these. So we have 2,550,750 plus 299,250. There's the 2.8 million. That's the total depreciation that was taken that is being recaptured now. And so of the 2.85, the portion that's ordinary is this 299,250, and then the difference there, whatever's left over, that's the unrecaptured 1250 gain. Now, again, I'll put a link to, go check out the other video on unrecaptured 1250 gains. But the reason why, that's important to separately categorize is it's subject to ordinary tax rates, but it's capped at 25%, right? And so that's really, really important. Now, if we go back to the return here and look at Schedule K for the entity so we can see how these numbers are flowing through, we've got Schedule K here, right? These are the distributive share items going to the partners. So line 2, that's the rental income, the net rental income and expense plus that Section 1250 ordinary recapture, right? So that's just ordinary income up there. And then down here on lines 10 and 9C, we have the 1231 gain, right, which totals 2.95 million. And then of the 1231 gain, that's 2.95, unrecaptured 1250 gain is the 2.5 million. So when this hits the returns for the owners, right, assuming they're both individual owners, they're going to have ordinary income up here, the line 2 items, and then the total 1231 gain or loss. This is initially treated as long-term, right? So it goes on Schedule D as long-term gain. But the portion of this that is unrecaptured 1250, which goes to that separate worksheet, is going to be $2.55 million. Okay, so I hope that was helpful. I think that covers everything that I wanted to address. I mean, again, I think what's important to remember here is when you're doing the 4797, line 26, for the most part now, you don't see it, right? Because you're putting property into service and selling it, and all this is happening post-1986. But if you do have a property that you've had for a long, long time, right, and so you were depreciating it using an accelerated method before you switched over to straight line, you could have an issue down here. Right, so and that's the case that we had with this real estate partnership LLC. Is we've had a property since the early 80s. It was depreciated using an accelerated method, and so for that reason, we're not changing the total amount of gain. Right, I mean the gain remains the same, but what we have to be clear about is what is the character of each component. And so in this case, we do have an amount that had to be treated as ordinary income, and then everything that's left over gets the 1231 treatment, and then the unrecaptured 1250 piece. Okay, so thank you for watching. Again, I hope that was helpful. If you have any questions, certainly leave me a comment below. Happy to answer any I can, and I look forward to seeing you again on the next video. Thank you.